I'm Judy Shaw for NYSE Floor Talk. Joining me today is Miguel Fernandez. He is co-founder and CEO at Capchase. Miguel, it's wonderful to have you here. Thanks for joining me today.
Thanks, Judy. It's great to be here.
All right, and I'm excited to talk with you, but before we do that, just a quick note to our viewers, this interview is for informational purposes only. The NYSE doesn't recommend any investments or investment strategies. All right, so Miguel, tell me, what does Capchase do?
Yeah, right. So Capchase is a fintech that helps SaaS companies with financing, payments, and workflow automation solutions. So these startups, they're primarily software businesses, and yeah, we've been working with them for the last 3 years, helping them navigate the different scenarios with those two things I mentioned.
Okay, so tell me, how is this relevant in today's market? Talk to me about lack of liquidity, regional bank struggles.
Right, yeah, so why this has been relevant for a long time since we started is because startups and SaaS companies in particular, software companies in particular, rely a lot on equity from VC investors, right? So they sell, periodically parts of the business to get money to then invest it and turn it into growth. What happens is that when these companies IPO, when they come here and they IPO,
yes.
Founders own a very, very small part of the business because they've had to fund all the growth with, by selling parts of the business. So what we did, how we innovated there, was we'd understand the revenue from these companies, we would understand the predictability, and then we would enable founders to access part of this revenue ahead of time, so they could invest that money into growth and fund the growth with the future revenues as opposed to fund it with equity, right? So then that was a very big innovation in 2020, 2021, and then last year, and this year even more so, when there's been a generally a lack of liquidity in the market, first due to the interest rates increase and valuations going down and VC funding pulling out of the market, then founders were looking at different options to continue to fund their business and to grow. And given that VC money was either extremely expensive or non-existent, we were one of the only options available. So that was a like a great cure for the ecosystem last year. This year even more so, with Silicon Valley Bank collapse and then the regional banks struggling, that has compounded the lack of liquidity. And Capchase, given that we have arranged billions of dollars in financing on our end, we are one of the only providers of liquidity to the ecosystem now, primarily to software businesses. So I would say that our mission is more relevant than ever. Mm-hmm. At the same time, the market is tricky, so we have to be careful that we are, working with the right companies and not in general, with everybody.
Right, okay. All right, so tell me, what's the impact in a SaaS company that uses Capchase, and how is it different from any other capital providers?
Right, so again, like startups or software businesses traditionally have funded all of their expenses with equity, right? Mm-hmm. But if you think about these companies, you can categorize their activities and like initiatives into two broad areas. You have long initiatives that are very uncertain, but if they have a good outcome, they will return a lot of money. Imagine launching a new product, entering a new market, acquiring a business, right? Like those are uncertain. They can take a long time, but if they work, they're going to generate outsized returns for these startups. At the same time, they have other activities that are much more shorter term in nature, and they're very predictable. And that's things like user acquisition or working capital, right? Like those, after a while, if you have a software business, those are really predictable. You know that if you put in X amount of money into growth, this is going to take a few months and then it's going to materialize into revenue, into recurring revenue in the future. So if you think about it, if you use equity money, which is very long-term and very expensive to fund everything, mm-hmm. you have to run out of it, because you can sink infinite amount of money into things like growth. So what Capchase does, and why it's different from any other sort of capital, is that it is a short-term capital solution that has a very low cost, much lower than equity. And it means that founders can now use equity, which is longer-term capital, very expensive, but that you don't really have to return in terms of cash flows. Mm-hmm. You use that to fund long-term activities that if they work out, it's amazing. If they don't work out, you don't have to return the money. And they use Capchase for the short-term predictable stuff. And this means that suddenly founders have much more capital to deploy and then have much more runway because their equity money, which is what determines really the runway, is used for just R&D, mm-hmm. and they use Capchase, which is kind of like recyclable and renewable, to fund short-term predictable activities.
Okay. All right, so tell me, finally, what's your best advice for founders and CEOs of SaaS companies to thrive in this economy?
Right, so I think that there's two big things happening in the economy, and all caused by the same thing, like interest rates and volatility. One is that there's less capital in the market, and the other one is that every single SaaS buyer is rethinking their budget, is wants to hold on to money. They don't want to pay upfront for anything because inflation is so high that if you can delay your payments, you're just making money just by that action.
Right.
So my advice, two pieces of advice for founders. One is they need to find sources of capital to grow into valuations that were set 2 years ago when the market was totally different. So look for non-dilutive capital that doesn't involve a repricing of the business. Things like Capchase can really, really help now. And then on the other hand, given that signing up additional users is more challenging now than ever, deal cycles are taking longer, and it's harder to convince people to pay up front. I would say focus on two things. One, focus on retention. Like customers that know the software business already are more likely to continue, and they're easier to renew than to sign up a new customer. And two, reduce friction at the point of sale in whichever way possible, either by offering payment terms or by giving more products that have a high gross margin at a lower cost, but whatever it takes to reduce friction at the point of sale.
All right. Okay. Well, Miguel, lovely to talk with you. Thanks for joining me on Floor Talk today.
Thank you so much, Judy.